Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. First, I just want to say I am loving the comments. All this month, remember, we are giving away swag, and all you have to do is subscribe and comment on our episodes. And each week, we will announce a winner. This week, Sam is our lucky winner. We're going to be sending him some sweet, sweet swag. This episode, I've got my Talk Finance to Me mug. Maybe you want to walk home with it. It's really simple. Just subscribe and comment. Now, on this episode, we've got Stan Wong on the show. He's with Scotia Wealth. He's been in the markets for a really long time, and he is super disciplined. He's a big valuation guy. He doesn't like to veer off course when it comes to valuation, but he made 3 very notable exceptions in his pro pick. So it's really fascinating to get insight into his disciplined process, but also he sheds some light on where he's willing to make valuation exceptions. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Now, we often talk about stocks, but a lot of people just invest through ETFs, and we want to help you with that as well. I've got Erin Allen, who's the Director of Online Distribution at BMO ETFs, to help us sort out this asset class. Thanks so much for being with me.
Thanks for having me.
So let's just talk first steps. How do you go about constructing a portfolio of ETFs?
Yeah, it can definitely feel intimidating off the hop, but it doesn't need to be. So first step is really to come with a plan. So identify clear goals and determine what your time horizon is, and then frame that up with what you're really looking to accomplish with your investments. Is it long-term capital growth? Is it less volatility? Is it steady cash flow? Or something else entirely. And then from there, you got to open an investment account. So either you can go the advisor route or you can go the do-it-yourself route with an online broker like BMO Investor Line, which is a really user-friendly platform. They also offer commission-free trading on over 100 of the most popular Canadian ETFs. So it makes it very easy and cost-effective to get started.
So 100 ETFs with all kinds of sector exposure. How nimble should investors be with adapting their portfolio to, sector preferences right now?
Sector ETFs make all that very easy. It makes it simple to tactically switch in and out of sectors. Popular approach is a sector rotation strategy. So a lot of investors try to align their sector exposure with where we're at in the economic cycle. So if you think we're in a recession or a contraction, you would overweight more defensive sectors like consumer staples or utilities, for an example. On the flip side, if you think we're in an expansionary phase, fingers crossed, hopefully soon, you might overweight more cyclical stocks like consumer discretionary or technology sectors.
Let's expand a little bit maybe on the defensive side of things, because that certainly feels like the vibe right now. What are some examples of defensive ETFs that BMO has?
Yeah, sticking with sectors, because BMO recently brought the SPDR Select Sector Index ETFs to Canada, trading in Canadian dollars with hedged options. 2 sector-focused defensive plays would be ZXLU for utilities or ZXLP for consumer staples. Another thing we're seeing investors flocking to is gold. It's recently reached near record highs. So something like our BMO Gold Bullion ETF, a ZGLD is an option there. And then lastly, I would say factor exposures are something that investors are leaning into a bit more, in particular low volatility. Something like ZLB, or BMO Low Volatility Canadian Equity ETF, is an example there that invests in lower beta stocks relative to the broad market. So it just means a smoother ride for investors.
Okay, so let's talk research tools, because when it comes to investing in stocks, there's a whole swath of research out there. BMO has, an army of analysts that are doing their digging on stocks. What does research look like for ETFs?
Absolutely. There's lots of research tools available, both from BMO Investor Line and BMO Global Asset Management. So on BMOETFs.com, we have 8 different tools, screening the entire Canadian listed environment, or a comparison tool. We also have a largest and most liquid tool that looks at just the ETFs with the most trading volume and the highest AUM. So that can be an interesting place to start. On the BMO Investor Line side, they have great tools for customizing, benchmarking, and tracking performance. So definitely encourage everybody to check out those tools.
All right. Thank you so much, Erin, for being here.
Thank you for having me.
For more information, go to bmo.com/investorline. Stan Wong, thank you so much for joining me.
Thank you so much, Amber, for having me on.
We've spoken so many times, but it's nice to talk to you in this format. Maybe we can get a little bit more unplugged. What do you think?
For sure. It's my first podcast, so let's go.
Okay, so let's talk about the markets. We have seen such a huge recovery in U.S. stocks, while Canadian stocks, the TSX, is right around all-time highs. Are you ready to put tariff anxiety to bed?
Well, I think there's always going to be bouts of choppiness because policy is going to be uncertain going forward. With that being said, the TSX up 16% from the lows, the S&P up 18%, NASDAQ over 25%. At this point, we're probably a little bit extended and we might have a bit of a pause, although yesterday we had a great market. I wouldn't put any anxieties behind me at this point, but at the same time, it would be fearful of putting money to work.
So investors have been so trained, honestly, for the last 16 years to buy these extreme dips. And there are people who come out and say pretty much every time, this time is different. Don't chase this dip for one fearful reason or another. Yet again, investors are being rewarded for buying this dip.
And hopefully a lot of investors did buy this dip. And again, it shows that the resilience of the market is something, and the economy is something that you don't want to avoid. And you want to be buying those dips when you can. And surely if you're a long-term investor, what happens over the next month or 3 months in terms of volatility shouldn't matter if you're looking at 5 to 10 years.
That's a good point. And it's so easy to say, but in those moments, like, I've reported on so many of those moments. You've actually had skin in the game in these moments when you're seeing your stocks down 15, 20% in a short period of time. So what did you do when there was that volatility about a month or two ago? Did you hold true? Were you out in the markets buying?
Yeah, so 7 weeks ago, we had this tremendous drop in the markets, but we looked at all the fear indicators, such as the American Association of Individual Investors. The bearish sentiment was off the numbers. It was very high. And the VIX index hit numbers that we hadn't seen since COVID. And whenever you have these types of numbers hit these levels, typically, and almost 100% of the times, you're going to have a positive market 12 months later, and you'll have a very strong return as well.
The thing is, though, you can see leadership shift, and the way you come out of the market is not necessarily with the leaders of the past. And I'm talking about tech here, and tech definitely has recovered. But over the past year, let's call it, there seems to be a handover from some of these tech stocks, from the Magnificent Seven to other areas of the market. Are you noticing that as well? And what does that tell you?
Well, from the lows, it's been a fairly broad-based rally. Obviously, some of the more cyclicals have done a bit better. We do expect that leadership will shift somewhat. Right now, we're seeing some shifting just geography-wise from the U.S. into some other markets like the EFI markets and European markets and so forth. And I do expect that some parts of tech may shift in terms of leadership because they are expensive in some ways.
Let's talk about how that shows up in Canada. I think it's very popular right now to talk about buy Canadian, especially in Canada, given, the state of relations between Canada and the US. But also our market is faring better so far in 2025. And as I mentioned, touching multiple all-time highs recently. Has the Canadian market become relatively more attractive to you? I actually just did the numbers. Out of the last 16 years, 13, the US has outperformed global stocks ex-US. This seems to be one of those years that the US is underperforming. Do you think it's a sea change or a flash in the pan?
I think it's so far. We're still, just approaching June at this point. I would suggest that much of the move in Canada has been because of the materials and particularly the gold sector. As always, the Canadian market is rather narrow in that we have resources and we have financials. So in those years in which those areas can perform well, then yes, the TSX will outperform the US. But At the end of the day, the US market and the international markets, you've got a much bigger sandbox to play in. You've got more depth of companies and a bigger selection of companies to choose from. So my expectations is that the US will perform well. Right now, there's some policy uncertainty that's moving a little bit of money away from the US, but I would suggest that you've got more depth there. And I would say that the Canadian economy seems a little bit more uncertain, especially when you look at the middle parts of this year, when you look at the expectations for GDP for the second and third quarter compared to the US. So I would say that waiting in the US makes more sense. We are certainly waiting more in the US with a shift towards international markets.
Given your conviction in the US, how do you think about valuation of US stocks broadly?
That's a great question. I mean, I think you have to break down how the S&P 500 is made up, which is, if you look at it, really almost 50% in technology names. When you incorporate Amazon as really a tech name, or Tesla, or Facebook, and Alphabet, which are classified in the communications area. So really, it's about 50% technology. So clearly, that makes that valuation rather elevated. So we look at individual names, and we'll certainly own some of those technology names, but we're looking at other parts of the market, such as financials and industrials and healthcare, which will make our portfolios cheaper in terms of valuation. So I think that valuation premium for the S&P 500 market is a bit skewed, just because we have a great number of names that in technology that make up the composition of the index.
Right now, we're a little worried about the bond market. There's been a huge sell-off in really global debt on a bunch of different things, but basically this idea that government spending and issuance is going to be high at a time where demand for that debt is pulling back. Simple supply-demand mismatch. How do you think about bond yields and whether it's going to be a problem for stocks going forward?
Well, first off, I'll say I love wading to areas in which people are worried about, because there could be opportunity there. I mean, yields are higher, so you're going to get paid better to hold fixed income going forward. I think that the corporate bond market and even the high yield market still seems pretty solid at this point. The economy in the U.S. continues to look fairly strong in the future or the near future. So we like that area. I think that yields for the time being have kind of spiked a bit, and maybe they'll calm down. We still think that interest rates will be steady going forward, not necessarily jumping higher or moving much, much lower.
You don't seem worried about, they call them bond vigilantes coming in, as the U.S. basically passes yet another huge spending bill. We did see a little bit of a tantrum about it in the bond market. And just to link it back to equities, there's a view out there that if interest rates become too high or these yields become too high, that presents a headwind to stocks. And it doesn't seem like you think we're in for a big sort of nightmare in the bond market.
Well, I think keep in mind, you can go short-term bonds, you can go medium-term bonds and long-term bonds. Obviously, the long-term bonds have higher duration and higher duration risk. So you can have a mixture of those short-term bonds, which you're still getting paid very, very nicely, even on short-term bonds and medium-term bonds.
So we're going to talk about a bunch of stocks. We got a lot of questions in the mailbag, but just give us a sense of your North Star or your approach to stock selection that will really color like how we talk about the stocks coming up.
Yeah, so my approach is a fairly complex quantitative approach that I use with a very sophisticated computer software program. With that being said, I would say that I would break it down to what I'm looking for in terms of looking for companies. Is number one, I'm looking for companies with very strong earnings growth, a great clear runway for growth. And secondly, I'm looking for companies that are in industries where there's very limited competition, and I just don't like crowds. I want companies that are by themselves or with a couple of competitors, and therefore they can command pricing and have great revenues and earnings going forward. So those two areas, a lot of my companies kind of fall into those two buckets.
One of the companies that's going to get a lot of airtime in the next 24 hours is Nvidia reporting quarterly results. How does that stack up against your metrics? Because for all the talk about Nvidia and AI eating the world, boy, the stock really hasn't done much. It's just been a sideways trader.
Yeah, so interestingly, Nvidia is trading at a valuation cheaper than it has been in a very long time. But there's a lot of sentiment about what's happening with China, what's happening with the chip sector, and what's happening with capital expenditures that's been holding back the stock. Certainly near term, however, Nvidia reports tonight will determine the short-term, very short-term course of the NASDAQ and the tech market and the semiconductor market. But I think longer term, the AI theme is a super theme and it's a long-term theme. Companies like Nvidia, ASML, and so forth are at the forefront, and they're the giants of those areas. So short-term, again, we'd look at short-term. Yes, lots of volatility can occur, but what's going to happen in 12 months, 3 years, 5 years?
So that's a name you'd still like here.
We do own Nvidia in the portfolio.
Okay, well, that's a freebie. Nobody asked about that one, but I had to get it in there. Okay, let's dip into the mailbag.
Sounds good.
Okay, our first question in the mailbag is about Couche-Tard. This one coming from LaFlemme123 on X, who's excited to see you in the podcast world. What are your insights on Couche-Tard medium to long term? We know they are trying to buy the 7-Eleven owner. I don't know where things stand on that. They seem in pursuit, but that's been a real penalty on the stock.
Yeah, we don't own this company in the portfolio. Clearly, it's one of these defensive type of names. However, it's trading at about 18.5 times forward earnings. That's slightly above 10-year historical averages. You're getting about an 8% earnings growth rate going forward forecasted, which matches its 5-year history 8% earnings per share growth rate. Technically, it looks a little challenged just given the fact that the stock price is trading below the 200-day moving average, which itself is trending lower. So the name looks to be something that I'd be a bit cautious at right now. You're getting a 1.1% dividend, nothing too exciting or anything along those lines. I think fuel margins are slowing somewhat in terms of growth and so on. Labor and wage inflation could be something that can impact these types of companies as well. And again, the valuation is a little bit elevated.
Well, let's get to a question to your point about a name that is outside technology. That's Brookfield Infrastructure. This one coming from the poor Oracle on X. What are your thoughts on a long-term position in Brookfield Infrastructure Partners? Is it undervalued?
I would say that one of the more attractive things about this name is that it's in the infrastructure space, which is expected to be more of a steady, cash flow rich type of business. You are getting a 5.2% dividend yield. We expect about a 5 to 6% growth rate in that dividend over the next few years. Surprisingly, the stock has a 1.5 times beta versus the TSX, which you wouldn't expect. What does that mean? Well, just the volatility of the stock relative to the index is 1.5 times. So it's a little bit higher than that of the TSX, which we wouldn't expect from this type of name. Technically, the shares are trading above the 200-day moving average, which itself is trending higher. So that's a good sign as well. It's obviously defensive infrastructure exposure, which we like: utility, transport, data, midstream, and so forth. They've got a lot of inflation-linked contracts, which is good in case inflation starts to move higher. But, they're in areas in which there could be geopolitical and regulatory risks where they're operating in other parts of the world. And then interest rate sensitivity. It is kind of like a telecom in some ways, in that if 10-year bond yields shoot up, that dividend yield that it's paying is not going to look as attractive.
It sounds like you're kind of lukewarm on this one.
We don't own it in the portfolio. It probably doesn't have the growth aspects that I look for in a name for our portfolio.
Okay, let's ask about a tech stock. We've got a question from Sam on Instagram. What are Stan's thoughts on Shopify? I got caught at $152.33. I love when people tell us where they're at. I assume that's the Canadian price. Is there anything in the pipeline in terms of news that we can expect? This one coming from Sam on Instagram. And Shopify, that can be, I would love to know the beta on Shopify, because that one can be a roller coaster.
It'll be high for sure. I would generally say that when I'm looking for technology names, I'm looking in the US and I'm looking in places like Europe at something like an ASML and so forth. Shopify is a name that I've never owned. I know it's done very, very well, but the valuation is quite restrictive in my opinion, trading at 72 times forward PE. Showing a 20% earnings growth rate. So then you're looking at about a 3.6 times PEG ratio, which
price
is a little
to
bit
earnings growth.
Exactly. So it's a little bit rich for me. And then when you look at the forward price to sales ratio is trading at 12 times price to sales. Put that in perspective, the S&P is trading at 3.1 times price to sales. So for me, I understand that the company has a good growth runway ahead of it, but it's just valuation-wise, it's pretty expensive. It's also very highly exposed to the small and mid-sized businesses, which can be vulnerable in any economic slowdown.
So that's interesting because you can spin a very sexy story about Shopify, basically a white label version of Amazon if they execute, and a huge total addressable market. And to your point, the growth has been there. But it sounds like you very rarely let these sexy stories get away from your discipline on valuation. It never tempted you. Have you ever broken your rules on valuation or when you're willing to buy?
Not usually. I am a very data-driven, numbers-based type of money manager. I'm looking at the numbers very carefully. There's a lot of names that look interesting. Outside of the tech space, a name that I really like, a name that I frequent is Costco. But we sold that because it was trading at 5 times a PEG ratio not too long ago. And I think that's a great franchise and has a great story around it, but the numbers simply don't add up at this point in terms of valuation relative to growth.
When did you sell it?
About a month ago.
Okay, so that was it's gone up a little bit since then, but you probably locked in a nice gain. Stocks can go up and the valuations can get even more crazy.
Absolutely.
That doesn't give you FOMO.
No, because we're going to shift to something in which the opportunity cost is better somewhere else. I mean, I would suggest that Walmart is in that same space in terms of valuation relative to like a Costco as well. That valuation is quite up there as well. A lot of money is kind of shifted. Sorry to get off topic on technology. Get off topic.
That's what the podcast is for.
A lot of valuation premiums have gone into this consumer staple space because of these concerns about economic downturn around the world. But they just become very expensive. And especially with what happened in April, a lot of those names got pushed higher. And a lot of cyclical names got, a bit cheaper, and we took advantage of those.
So that's interesting. You think Walmart's too expensive right now?
Walmart's up there similarly to Costco.
You just talked about Couche-Tard being too expensive.
Yes.
So people might think, okay, I'm worried about the consumer. I'm going to go to these more staples names. Your valuation is saying that might not offer you the safe haven you think.
Well, as you know, markets are always looking forward 6 to 12 months. So if we're worried about some sort of downturn, which I'm not in that camp, I think that a lot of these names have already been pushed higher today relative to where people think the economy will be in 6 to 12 months.
There's a perfect example of that this week in Abercrombie & Fitch, which is a very discretionary type of retailer. And they did a little bit better than feared, and the stock shot up like 25%. And it's been beaten up, but that kind of does speak to your point. At some point, investors feel comfortable stepping in when the news is less bad.
Agreed. Some of those higher beta, retail clothing type of names are a little bit trickier because, as you know, trends can change and fashions and fads change. And you look at a stock like Lululemon, that's been all over the place. Yeah. But, good branding, good name, more of a trading stock in my opinion. And I would sort of put names like Aritzia and ANF in the same space.
Okay, let's see if we can find some other stocks that pique your interest. We're going to take a quick break now, and we'll be back with more of your questions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, we're back on the podcast. There are clearly trends away from maybe consumer staples because you think they're getting rich and you don't like the fickleness of retail. One consumer stock that we got a question on is on Uber. And I guess you could think of it as a tech stock as well. What are Stan's thoughts on Uber? This one coming from Jim. How do you think about Uber? Is it a tech stock? Is it a consumer stock?
I think it's a complicated name because you've got the ride sharing, you've got the food delivery, you've got their relationship with Waymo as well. And then in the back of my mind, I'm thinking about my son ordering Uber Eats all the time at his university, costing me lots of dollars.
I was going to ask on whose credit card?
My credit card for sure.
Bank of Stan?
Yeah, that's right. Uber's a bit expensive for me right now. It's trading at 31 times forward price earnings with a 9% growth rate expected. So you're looking at about a 3.5 times PEG ratio. Its 5-year historical growth rate was 29%. So you compare that with the forecasted growth rate of 9%, there's a lot of earnings variability here. And one of the things I look for is steadier earnings than something that goes from 29 to 9%. So, we understand that ride sharing and food delivery is a big market. With that being said, I think there's a lot of regulatory risks around ride sharing because in different markets, governments and different bodies are looking at ride sharing differently. There are certain towns that don't have Uber or Lyft in Ontario that I was not even aware of. In Europe, Bolt is doing extremely well. So I think that Uber is having some issues there, trying to compete. So lots of competitive pressures there. Higher beta stock as well. And then we got to think about AV, autonomous vehicles down the road. Like, although they have a relationship with Waymo and they're collaborating, Waymo is going to different cities right now and doing it their own thing. So without that cost of drivers, I think that the competitive pressures will only get bigger as time goes by.
I mean, it's sitting at an all-time high. I sold this one too early. I think I had like a 20% gain. I'm like, oh, goody, I'll just take this one and go home. But, I feel like our conversation on what is this stock, is it consumer, is it tech, is important to what you do going forward, right? Because I almost think it's veering. Their growth is slowing. They are seeing competitive pressures, yet the stock is moving higher. It's almost veering into concept territory. It's becoming a concept stock on robo-taxis.
I think so. With that being said, if you look in the past year, that 200-day trend has really been rather flat. So that longer-term trend line is showing to be a little bit flatter. Most recently, it's kind of spiked a little bit in the last couple of months, but we'll see if that holds.
This one is a consumer name, and I'm tracking it right now, trading at the highest level in 2 years. It's Canadian Tire. I would like Stan's opinion on Canadian Tire, this one coming from G. Young. And I would think that a rally in Canadian Tire would be surprising to many right now because we're concerned about the Canadian consumer, recession fears, slow housing market. And then here we are talking about Canadian Tire sitting at a 2-year high.
Yeah, I think it just hit a high yesterday. And it's surprising because as much as I shop at Costco, I never shop at Canadian Tire. And that's just my personal approach to shopping. It's trading at 13 times forward earnings with a 13% growth rate, which kind of surprised me when I looked that up going forward. It has a 4% dividend yield. So I think that dividend yield is attractive to a lot of people. On the bullish side, I think that if there's some international retailers leaving Canada, that's going to be a benefit to a company like Canadian Tire. They've got what I understand to be a strong brand and loyalty program in the Triangle Rewards program. I think SportCheck or the Farzani Group is doing well for them. They recently purchased, I guess it wasn't that long ago, Party City assets as well.
Well, I go to 700 birthday parties a year.
Oh, well, there you go. Maybe that's what's driving the stock.
Party, so maybe it's me. I mean, yeah, you make a lot of good points. The Bay is gone. They beat Target all those years ago. At 13 times, is that a cheap stock? Like,
I think from a absolute perspective, I think it's a cheap stock. And, the forecasts are looking at 13% earnings growth. I'm not quite certain where that's exactly coming from because, again, I'm not a shopper at Canadian Tire or Mark's Work Warehouse, or I'm not at Party City as much as you are. My kids are older. So, I think from an absolute view, it does look cheap. With that being said, I like companies with a little bit more growth and are in areas which are in more limited competitive markets.
I wonder, too, if it's benefiting from Buy Canadian right now.
It could be. It very well could be.
Okay, one stock, oh gosh, the headaches keep coming for this one. It is UnitedHealth. I would love Stan's thoughts on UnitedHealth. This one coming from Corey on Instagram. This is a blue chip insured, one of the most influential stocks on the Dow. And in the span of less than a month, it has dropped 50%. That just doesn't happen, right? It's not very typical. And the reason it happens, just to backstory it, is they're basically warning their expenses, how much they have to pay for medical programs is going up at the same time that, the reimbursement that they're getting from the government is lower. That's like one story. There was also an assassination of their CEO, which really made it a political stock because of their practices when it comes to covering necessary health care.
And I think the biggest thing also is the fact that the DOJ is investigating areas of fraud that may or may not be happening within the company. I think on the positive side, we see UnitedHealth insiders buying stock heavily, which is positive. With that being said, there's not a lot of technical support here, given how fast the stock has fallen. Perhaps there's some at 250 and there might be some at 270 or so. The PE has dropped to levels that we haven't seen in a very long time at around 11 or 12 times. But the earnings growth rate has also dropped around 7%. I think this is a bit of a wait and see approach at this point. You could be buying a leader in its field, which UnitedHealth is. It's a giant in its area at a very cheap multiple. But I want to see a bit of a proof via the stock price sort of just moving up a little bit above certain resistance levels before I would jump into this. With that being said, I did own this stock, and not because I knew the DOJ was going to investigate. We sold this a few months ago.
So before, you got out at a great time.
Yeah, we actually sold it during the spike when kind of money was going over to the more defensive areas.
And what made you sell?
We were looking for cash to build. We wanted to sell more defensive areas, as I sold Costco a little bit before that, to move into some of the more cyclical areas that were cheaper.
So let's spend a minute on this because I think it's a good teachable moment. The drop in UnitedHealth was sudden and swift for such a large company, but there are examples of companies of this size and scale that find themselves in hot water, existential crisis, like a Boeing, like a 3M, where eventually bold shareholders are rewarded for stepping in at times of crisis. And that was true with Boeing, though you've had to put up with a lot of volatility if you got in at the right point. And it is true of 3M. Again, if you caught it at the right point, you see huge gains afterwards. What would you say to the tempted investor?
I agree with those comments. With that being said, I've been doing this for 25 years. We've also seen companies completely disappear, such as an Enron, and I forget the telecom company that went bankrupt in 2000 as well. Those instances occurred as well. So whenever you start reading things about potential fraud in a company, I think you want to take a step back and be patient with these names, or you take a very small position with it so that it doesn't hurt you if it goes down a lot further.
Okay, our final question, and this actually is probably our most important question. I'd like Stan's thoughts on the Raptors making the playoffs next year. This one coming from GW on Instagram. Be thoughtful about this.
Sure. Obviously somebody knows that I'm a big sports fan. I'm a Raptors season seat holder. What's interesting is that a colleague of mine from the East Coast, New Brunswick, sent me a message the other day saying, just wanted to check on you. I'm doing a wellness check on Leaf fans. And I thought that was hilarious. Right now, I'm focused on, the sole Canadian team, Edmonton Oilers, getting into the Stanley Cup finals and maybe winning the cup. But when it comes to the Raptors, I think that honestly, they've picked up some very good talent. I think they'll definitely be in the play-in tournament next year. And I think the playoffs are a good possibility. So fingers crossed for next year.
You talked about that just like it was a stock. And I love that. Thank you very much. Okay, that's it for all the questions. But it is time now for Pro Picks, Stan Wong's highest conviction ideas. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit ATB.com/inthemoney for more information. Okay, now it is time for Pro Picks, Stan Wong's high conviction ideas. And your first idea is Dollarama. And I'm going to immediately take you to task, Mr. Valuation. You don't like to buy expensive stocks. And your first recommendation is Dollarama. How can we not call it an expensive stock?
Well, I would say that in the beginning of the show, I said that I like companies that are in industries with very limited competition. And Dollarama doesn't really have a crowd. They really don't have a lot of competition in the mass merchant dollar store space. There's very few. Yes, Dollar Tree is up in Canada, but on a very limited fashion. The valuation for some of these names, you're going to pay a bit of a premium because they really have no competition and they have a great runway for growth and they have great pricing power. You are paying about 39 times forward earnings for Dollarama, but you're getting about a 14-15% long-term growth rate forecasted going forward. They've grown about 19% over the last 5 years per year. I think that with the Canadian economy looking a little bit uncertain, household debt being at near all-time highs, if not all-time highs today, the cumulative effects of inflation since the pandemic, I think you're seeing a downshift in the type of spending that's happening with Canadian consumers. People are cutting discretionary expenses, prioritizing essentials, and really looking more for value. One thing that I found out about Dollarama is that they have 60% of their sales is in private label products, which is obviously very profitable for them and beneficial. They're looking to grow to 2,000 stores by 2031. That playbook will continue to perform well for them, just given the fact that they've done so well with the stores that they're at today, which I think is about 1,500 stores. And then you've got Dollar City in Latin America, which is, I think, a bit of a hidden growth engine.
And they, being Canadian, they don't have to deal maybe with the tariff anxiety on Chinese importers to the extent that its U.S. peers do.
Not so much. And I think that, as you know, there's really nothing for $1 at Dollarama or any other dollar store.
$5 yeah.
And they've pushed up to the $5 mark, which will expand their revenues and their profits as well.
It's such a beautiful stock. Just to it's at an all-time high. And normally it can be tricky to buy things at all-time highs. But going back to 2010, it has only had 1 year where it's been down, and that was 2018. So that is quite a track record of easily plus 20% growth. Most of the time, it's plus 25% growth.
And one of the things to look at is since they IPO'd back in 2009, the stock price on a total return basis is up 5,540%. The TSX is up 262%. So it's a comparison of nearly 30% annualized returns versus 8.6% from the TSX. So clearly the technical chart, don't even need to mention it's a series of higher highs and higher lows, trending higher. And as long as that competition remains limited, Dollarama will do very, very well.
Your second pick, less of a household name, is Mercado Libre. And this, is it a retail play in Latin America?
Yeah, you can think of it. A lot of people think of it as the Amazon of Latin America, but I kind of think of it as the Amazon, the PayPal, and the Shopify of Latin America because they have a heavy presence in the fintech space, which is actually their higher growth area. They're obviously in e-commerce as well. The shares are trading at 47 times earnings with a 35% expected long-term earnings growth rate, which is phenomenal. You're looking at 1.3 times PEG ratio, which is fairly cheap for this type of growth rate. Its historical 5-year growth rate has been 50% a year. So really, it's a digital powerhouse. So think of it as Amazon without the cloud, basically, but also add on PayPal and Shopify. The fintech division, which is Mercado Pago, which is Pago represents payment in Spanish. That's really moving more so into that full-scale digital banking space. Profitability is really scaling with the business as well. And there's really not a lot of competitors, which is another reason why I like this name.
Another stock that's at an all-time high that's trading around 50 times earnings. Why does that make sense to you?
Because the growth rate is so phenomenal. You're looking at 35% growth rate with almost no competition in the fintech space and very little competition in the e-commerce space.
And I think there's something to be said for buying stocks at all-time highs that are making highs in a nervous market, right? One of the things I've learned, through doing this show is to not be afraid of that relative strength. I think there's a temptation to look, I'm such a sucker for these UnitedHealth stories where they drop 50% because I think I'm going to have an edge. But I find in my portfolio, the winners are the ones that have been the winners.
Yeah, and I'm a big believer in highs, bring more highs, basically. And if these companies can prove themselves in times like we've had these volatile times, that tells me something. That tells me that there's a lot of strength in the numbers behind these companies. So I think that it's great to try and pick some of these companies that are down 50% or 40%. And we will do that. But we like to do that with companies that still have these great earnings growth rates. And Liberation Day and those few weeks in which things drop 20%, 30%, that's, like a kid in a candy store.
Speaking of which, Netflix certainly got hit on that Liberation Day, but is now trading at an all-time high. It's not technically the Magnificent Seven, but boy, it has been a magnificent stock. Took a while to get back above its 2021 peak. But then when it did, it's like, where does this thing stop?
I think Netflix is running very hot on all cylinders. The shares are trading at 45 times forward earnings, which is expensive by itself, but you're looking at a 25% long-term growth rate expected. Its historical EPS growth rate is about 23%. So its forward earnings is similar to its historical earnings. This new ad tier business is adding consumers in which they didn't have before at a lower cost and lower revenue base. So they're increasing their subscribers. The password sharing, we're all guilty of it. That's working well for them as well. That crackdown on password sharing. And you're seeing a lot of content in different regions, which is attracting local subscribers. So really the drive is to more international subscribers.
The thing, Netflix for a while seemed like a tariff immune stock. And then there was that kind of Trump post on Truth Social that he wants to tariff things that are made outside of the US, like films that are made outside of the US. And then it was kind of a poof. And then we don't really know, how would that be enforced? How does that affect a Netflix? How confident should investors be that Netflix is tariff proof?
Well, I think the market has really told us that they were worried for a day and now we're at all-time highs. So I don't think there's a lot of concern with it. I don't really see our earnings growth numbers change very much. I think we look to the positives on the stock, again, with the ad tier opening up new consumers, with the password sharing crackdown, with their ability to raise prices and nobody blinks an eye, because I think that their pricing, it's really inelastic demand. People are just willing to pay that extra $1, extra $2 every couple of years, and they're fine with that. And then this move into something that we didn't expect 5-10 years ago, which is the evolution of streaming, is getting to live events, whether it be boxing, whether it be WWE sports entertainment, or it could be NFL on Christmas Day. These are new frontier type of areas in which we never thought, like before, where we thought about cable TV. Well, where else are you going to watch a live sporting event? Well, now you can watch it on Netflix.
Why Netflix over Disney? Disney is benefiting from a re-rating recently, and it's so much cheaper. They've also got streaming, and Disney is not optional in my household.
Sure, yeah. I have Netflix in our household. I have Disney in our household, but I think that Netflix really appeals to a much, much wider audience. And I think they appeal to a lot of local audiences in international markets, whereas Disney has their content and they're building some new content, but then they've pulled back on what type of new content they want to do because it just costs too much. Netflix has really been able to put more money into new content, which is driving more subscribers. Again, with Disney, you've got other areas to concern with as well, which is their ESPN and their networks and so forth, which is, clearly on a bit of a flat line or decline. And who knows what happens with theme parks, because it really depends on how strong the economy is going forward. So Disney, you've got other moving parts to it. Netflix, you've got the straight streaming. I think that it's proven that Netflix is not just a COVID winner, it's an all-time winner. And that's what we're seeing today with all-time highs.
Stan, thank you so much. Great insights as always.
Thanks for having me.
That's Stan Wong joining us of Scotia Wealth. Make sure you stay tuned to our next episode. We've got Josh Young joining us. He's at Bison Investments and he focuses on oil and gas. He's an American investor, but he loves Canadian energy stocks, and he'll tell us why on the next episode. Get your questions in now. You can email us at questions@inthemoneypod.com or find us anywhere on social media at InTheMoneyPod, and we'll see you on the next episode.